Hello folks, this is Steve Lentz with Discover Options. Welcome to the Morning Market Huddle. Today is July 15th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. You know what? Every one of us that trades options has a playbook. Every one of us has a playbook, and whether you know it or not, yours might be thin, yours might be real thick. You might have yours very organized or disorganized. One play you might want to have in your playbook is called a calendar spread. Now, we're going to evaluate strategies using a grid much like this. And here is a grid showing you what owning long stock would look like. Now, I'm going to get my little pen here. And notice that we have a grid with the X and Y axis. On the bottom, we have the X axis. As Apple goes up in price, our 100 shares is going to make money here. As it goes up in price, we move to the right and we go above the profit line. The profit line is on the left. Anything above this zero break-even line is profit. Anything below that is loss for that trade. And if we're long 100 shares of Apple, you can see that if the price of the stock goes up $5, we will make $500 on 100 shares. Real simple. If the price of Apple goes down $5, we will lose $500 on 100 shares. Okay? Now, let's take a look at a calendar spread. In the world of options, we can do spreads where we sell one option over here and then buy another option over there. Here, Apple is trading at $173.92. That was the closing price yesterday. And if we were to go to the 175 call, the 175 call, that's a little bit out of the money. All right. In the July options, with only 5 days ago as of yesterday's closing, there was roughly $3.48. That was the market price for that option. All right. Now in 5 days, all right, all of that $3.48 is going to go bye-bye. If the stock doesn't, move up, actually all of it's going to go out the door, even if it goes up. You know why? Because all of that is time premium. Option prices are made up of two types of price. Two types of value, extrinsic and extrinsic. Intrinsic is in the money options, how much intrinsic value there is between the stock price and the strike. Or extrinsic value is the pure amount of time decay on all out of the money options. All of the value is extrinsic time premium. This $3.48 is time premium that's going to go away in 5 days. Now, over in the August options, it's priced at $10.57 a share. In 5 days, how much time premium is going to leave that option? All right, well, when you model this using OptionView like I did before this presentation, we discovered that about $1.05 would go away on that $10.57, roughly $1.05 in theoretical time decay. So if the August loses $1.05 and the July is going to lose $3.48, are we going to make money if the stock just sits here? Well, yes, absolutely. Now let's graph this position. Okay, let's graph this position, and here's what you get. It looks a little bit different than the long stock position, doesn't it? It looks a lot different. This is the beauty of options. We can bend the risk graph to be more market neutral. We could be a little bullish, a little bearish. We could make money if the markets go up or down. All right. Now this calendar spread is going to cost us a debit of roughly $7.09. Given these prices here, we're going to have to buy that distant option for $10.57. We collect $3.48. We're going to be out of pocket $709. $7.09 a share. How many shares does a contract control? 100. All right. Now when we look at this risk graph, looks real interesting. At expiration, you can see that we could make $280 if the stock stops right at 175. If in 5 days or at the end of Friday it's at 175, we're going to make the most amount of money we can right there. Okay, if it moves too far and too fast, we can then start getting underneath that zero break-even line. All right, but here's today's line right here. In time, that time decay differential is going to kick in, and in just a couple days, you could see that for every one lot we put on, we're going to make over $70 if the stock just sits here like this. Now, it's not going to just sit here like this. We know that. But you can see how calendar spreads work and that you're taking advantage of that time decay differential. Okay, let's move on. Today we're going to look in our morning market huddle, and if you're interested, go to our website and register for our newsletter. You'll get on our mailing list and you will see the full 30-minute plus version of this every Tuesday and Thursday morning at 8 a.m. Central. But today we're going to talk about an earnings search. In Option View, we can click the E button and get a list of stocks coming out with earnings either at the end of today or at the beginning of tomorrow before the market open. And here's a list of stocks coming out with earnings. We're going to take a look today at Lufkin real quick, L-U-F-K. And when you look here at the history we have for our mentoring students, we have the stock analysis report. And here you can see how much at earnings the stock has gapped and then finished up for the day. Look at the most recent earnings. It gapped 2.66%, finished 13% up. All right, that was the last earnings. Now, when we go to Lufkin, we take a look at the possible calendar spreads we can put on, and what we notice is that the front month has much higher implied volatility than the back month. And that's due to the earnings coming out. But you know what? When you sell an option with a much higher implied volatility than the one you're buying, that can make for some real interesting and profitable risk graphs like this. Okay, here you could see that even if the stock moves down near 78, we're going to make money here in 5 days. Of course, we have all this leeway going to the upside, past 90. Okay, not too bad. That's if we're bullish. If we're bearish, we would go and do this at the 80 put instead of the 85. Lufkin's at 82.5 right now about. Here's a bearish calendar spread. And if you were to do both of them, you would be a bit more neutral like this. But what's going to happen here is that when earnings comes out here before the market open tomorrow, the implied volatility in these front months is going to collapse, and that's going to make the risk graph look even better than this. All right, we just got to hope that the stock moves down, or in this case, or doesn't move up too much. Okay, that's where the bet is. We're going to play that volatility switch off there, the plummeting IV in the front month, and we'll just see where this is. On Thursday, we're going to revisit this. We'll dissect what happened when earnings came out, and at the next day, we'll just take a look at the action as it occurred, and we'll see what happened. It'll be very educational. I'm Steve Lentz with Discover Options. We offer really the finest curriculum you can have in a mentoring program for options trader. We give you private sessions with veteran market makers. We help you develop a trading plan and develop that thing and flush it out. And we deal in both directional and non-directional strategies, and the calendar spread is one of those. If you're interested, give me a call or email me. I'd be glad to speak with you. Have a great day today. Good luck trading. Take care.